The new Fed chair just changed his mind about canceling your mortgage bailout. 6 weeks ago, I told you Kevin Warsh had a plan to quietly inflate away $39 trillion in government debt, and that the exact same move would quietly cancel your mortgage along the way. And I didn't pull that out of my keister. On April 20th, under oath, he handed me the receipt. He told the Senate Banking Committee, quote, "A rigid 2% inflation target is asking for trouble." The translation? He wanted room to push more inflation. Then he took the chair. And then, on June 17th, at his very first meeting running the Federal Reserve, Warsh stood at the podium and made a 6-word promise. This committee will deliver price stability. New translation? No inflation push. The opposite of what he said in April. It was like watching a militant vegan swallow a honey-baked ham whole at the PETA fundraiser. And Wall Street believed him. The Dow dropped 506 points that afternoon. The 10-year Treasury jumped to nearly 4.5%. And the traders who bet real money on this stuff now give it better than 8 in 10 odds that the rates finish this year higher than they are today. Not lower, higher. And thank you to Block Trust IRA for sponsoring today's video. More on that to come. So if you're sitting on a 3 or 4% fixed rate right now, and it feels like the tide was about to turn even more in your favor, you've got exactly one question. Is my mortgage bailout dead? So I ran it down to see. I went through his Senate testimony, his first press conference word for word, and one report published inside the Federal Reserve itself that almost nobody covered. And it came out that he flipped. This is a massive change, but not necessarily the direction. He didn't change his mind. He changed the thermometer. And if you've ever been up at 2 a.m. with a sick kid, you already know exactly how this trick works. Your kid is running a fever, 102. You tell your spouse, don't worry, I'll get this fever down to 98.6. That's my promise. Now, there are 2 ways to keep that promise. Method number 1, you actually fight the fever. Medicine, liquids, rest, the whole thing. Method number 2, you go to the drugstore and you buy a different thermometer, one that reads 2 degrees cooler. Same kid, same fever. But now the thermometer says 100. So you announce, hey honey, we're almost there. And you take a bow. And then you send the kid to school to infect the entire 2nd grade. The promise sounds identical either way. The only thing that changed is the instrument. So hold that picture, because in a minute, I'm gonna show you the new Fed chair, in his own words, at his own podium, telling you which thermometer he's planning to use. And when you see it, this whole flip is going to make a different kind of sense. Let's start with the cancellation of your mortgage, the inflation that was going to run hot and quietly shrink the real weight of your mortgage every single year. Did he just turn it off? Well, let's go to the tape. June 17th, first press conference. A reporter asks him about the Fed's 2% inflation target. And Warsh says this: "I tend to focus on the left of the decimal point." Well, the 2 is the left of the decimal point. The 2% target isn't 2.0 anymore. In this man's own framing, it's anything that starts with a 2. 2.4 starts with a 2. 2.9 starts with a 2. That's the logic of a man who owes you $299, hands you $200, and calls it even. Hey, they both start with a 2. Under the old management, 2.9% inflation was a problem to fix. Under the new framing, it's within the range of a promise kept. So for years, Warsh has said he prefers a measure of inflation called the trimmed mean. It comes out of the Dallas Fed. And here's how it works in plain English. You take every price in the economy and you line them up, the biggest drops to the biggest jumps. Then you chop off the extremes at both ends, including a big chunk of the fastest rising prices, and then you average what's left. The stuff jumping the most, trimmed, off the chart, gone. It's like stepping on the bathroom scale, deciding your torso doesn't count, and announcing that you've hit your goal weight. So what do the 2 thermometers say right now, today? Well, the regular one, the one that includes the gas, the groceries that you actually pay for, it reads 4.1%. The trimmed mean, his preferred one, reads 2.4%. Same economy, same prices, same grocery store. One thermometer says the fever is running hot at 4.1, the other one says 2.4, which you'll notice starts with a 2, left of the decimal point. Hey, promise is on schedule. And listen to the name they gave it, the trimmed mean. Trimmed, like fat off a steak. And which prices got trimmed? The ones rising fastest. The gas, the groceries, your prices. You didn't get counted, you got trimmed. But I noticed something else. This spring, economists inside the Dallas Fed, the very people who build and publish that trimmed mean, put out a report warning about their own thermometer. They showed that back in 2021, when prices got lopsided, when a bunch of things spiked at once, the trimmed mean read low. It lagged. It undercounted the inflation people were actually living through. And they warned that the same distortion could happen again, specifically because of the oil disruption coming out of the Middle East right now. The people who manufacture the thermometer put a warning label on it this spring, and the new Fed chair just peeled the sticker off and used it anyway. And he did one more thing. At that same first meeting, he took the Fed's public statement, the document the whole world reads to figure out what's coming, and he cut it down to almost nothing. No forward guidance, no hints about the next move. You see, this is significant because every Fed official submits a projection for where rates are going, represented by a dot on a chart, the Fed's dot plot. 19 officials, only 18 dots. I did not submit a dot, Warsh said. For me, it's not helpful. And think about what forward guidance actually is. It's Fed speak for warning you what they're about to do to your money. He didn't cancel the plan, he canceled the warning. And this week, the minutes from that meeting came out. 15 pages, straight from the Fed's own website. Inside, the committee gamed out two futures. If inflation comes down, almost every member says hold or cut. Clear as ink. If inflation stays hot, quote, policy firming would likely be warranted. Policy firming. That could mean a hike. It could also mean do nothing for a little longer. One branch written in ink, the other one written in jello. So let's walk through what actually happened in those 6 weeks in plain English. Warsh is promising harder than ever to fight inflation and promising to beat it. But he's stopped telling anyone how or when or what would even count as beating it. The louder the promise gets, the less he shows you. That's not how confident people act. That's how people act when they don't want you watching the details. That's not confidence. That's cover. So let's look at the one thing that doesn't care what anybody says at a podium. Let's look at the math. The government owes $39 trillion. The scary part was never the total. It's the payment schedule. Roughly $9 trillion of that debt rolls over every single year and gets borrowed at whatever rates are that day. The Congressional Budget Office says interest on that debt is on track to be the fastest growing major line item in the entire federal budget. Not defense, not Medicare, just the privilege of borrowing money we already spent. Now, hold Warsh's tough talk up against that. Every rate hike he threatens doesn't just hit your neighbor's HELOC. It raises Washington's own interest bill on $9 trillion of annual rollover. He's a doctor prescribing medicine his own patient can't afford. Now, he can write that prescription with a straight face for a quarter, maybe two, but he can't fill it for a decade. The math will not let him. Now, in his first tour at the Fed from 2006 to 2011, Warsh was famous as a hawk, the tight money guy, the inflation fighter. Then, last year, he flipped. Came out publicly for lower rates, said new technology would keep inflation down. No problem. Now he's in the chair, and the hawk suit is back on. That's 3 positions in one career. Now, I'm not telling you that to call him a liar, no. I'm telling you because it settles how you should listen to him. You don't watch what this man says. You watch what the math makes him do. And right now, the math leans toward an eventual cut, even if he throws a hike at you on the way there. And that's not just my read. Buried in this week's minutes, the median forecast has no moves for the rest of this year, and cuts penciled in for early next. Now, here's the part I can't prove, but here's what I think is happening. I think the flip is the playbook. Go back to the 1940s, when Washington quietly melted 70% of war debt out from under the people holding it. That trick, it had one requirement, and it wasn't secrecy. It was trust. Savers had to keep their money parked in savings accounts and bonds, earning less than inflation year after year without bolting. And the only way savers sit still for that is if the people running the system look them in the eye and sound completely, utterly credible about protecting their money. You cannot run the quiet inflation playbook while admitting you're running it. The tough speech isn't the opposite of the playbook. I think it's page 1. That's my read. I can't prove it though. I mean, nobody can. The man deliberately stopped publishing his forecasts, which tells you something all by itself. You see, I'm holding 9 fixed rate loans right now. I watched that press conference live, and I didn't change a thing because my read is he's still going to push inflation at some point. He'll have to. Because look at the only 2 ways this goes. Branch 1, I'm right. The hawk suit is a costume. The leak keeps running, and it's running at 4.1% right now against your 3% rate, which means your mortgage lost more real weight in the last 90 days than the year before. So you win. Branch number 2, I'm wrong. And he means every word. He hikes, he holds, he actually drags inflation down to 2.0. And understand what that world looks like. The Fed is sitting on roughly $2 trillion of mortgage bonds, and Warsh has said in his own writing that he wants to sell them. When the Fed sells mortgage bonds, new mortgage rates go up. So rates stay high for years. The refi window rusts shut, and your 3% mortgage becomes the rarest financial artifact in America. Something nobody will ever be offered again. So you also win. The only person who loses on both branches is the one who gives that contract back. The one who listens to the old conventional wisdom, rushes to pay off a 3% loan while holding cash that earns less than inflation, and hands the bank back the one contract it wishes it never signed. And your mortgage isn't the only place they've run this play. Wall Street sells you a 401k with a glossy brochure of a silver-haired couple laughing on a sailboat, promising you that if you just hand over a slice of your paycheck for 40 years, everything's gonna be fine. But then Washington swoops in and rewrites the rules on it every couple of years. It's maddening. It's like playing Monopoly, but every time you pass go, the banker reaches into the box, changes the rules, and pays you in Chuck E. Cheese prize tickets. So the real question is, what do you actually do about it? If your instinct right now is to own assets that the system cannot just magically print more of, you're absolutely right. You want gold. You want property. You want things you actually control. Well, there's a modern companion to that thinking, a managed crypto IRA. Now, I know what you're thinking. Matt, are you telling me to gamble my retirement on a digital dog coin? No, of course not. We're not talking about day trading, watching candlestick charts at 3 a.m., sweating through your pajamas. What we're talking about is diversifying for an uncertain future with a small professional Bitcoin position tucked safely inside a retirement account held in a place where you control it. I mean, if you're staring down the barrel of retirement, this is not about getting rich. This is about what your dollars will actually be able to buy 10 years from now. Here's how it works. Your coins sit with SFOX, Institutional Custody Cold Storage. An AI system called Animus watches the portfolio around the clock and rebalances by the rules, not by panic. So here's what to do. Go to epicrealcrypto.com and book a call. No pressure, no sales pitch, just a straight conversation about whether this fits you, and then you decide from there. Right now, they're putting up to $2,500 in Bitcoin into qualifying accounts. The terms are on the site, and you should read them because reading is fundamental and also legally binding. Go to epicrealcrypto.com, book your call. That's the first step. That's them. Now, here's a second move that costs you nothing. Pull out your mortgage note or log into your lender and open the loan details. You're looking for one word, fixed. If it says fixed, you can exhale. Everything this man does, hike or bluff, your payment is carved in stone, and both branches of this story break your way. If it says adjustable, or you're carrying a big balance on a home equity line, you're the one person his flip has actual teeth for. And you want to know that before his next meeting, not after. And then mark one date on the calendar, July 14th. That's like any day now. That's when the next inflation report comes out. That's your first scorecard on which Warsh is actually going to show up. And here's what makes you different from everyone else watching that report. When that number comes out, the news will read it like a scorecard. You will read it like a lie detector. If it starts with a 3 or a 4, inflation is still running hot. The promise is already broken, and the leak on your mortgage is still wide open. Everything I showed you today is confirmed. If it starts with a 2, fair is fair. He gets a point. But now you know the question nobody on TV will ask. Which thermometer got us there? Did the fever actually come down? Or did they just read the friendlier gauge? Either way, Tuesday the 14th, you'll know exactly what you're looking at before the anchors finish explaining it to everybody else. So the choice in front of you is simple. You can listen to what the man says into the microphone, or you can watch what the $39 trillion makes him do. One of those changed 3 times in one career. The other one hasn't changed once. And while Warsh was standing at the podium promising price stability, JP Morgan's private bank put out its 2026 outlook. Not the stuff they publish for you and me. No, the one written for their wealthiest clients. And buried in that report are 3 words that put my read in writing. And that's why I pulled this video right here out for you to watch next. Because Warsh tells the cameras what he needs you to believe. JP Morgan tells its clients what's actually coming and what to do about it. So watch this next if you want to know what the smartest money is about to do. God loves you, and so do I. Take care.